And so this will come back down to earth. It will revert to the mean. And usually, if the crash is not papered over, it will shoot past the mean before the reversion is completed.
GoldSilver.com. Price match guarantee. Free shipping. Global storage options. Phenomenal customer service. Get the best-selling book, Guide to Investing in Gold and Silver, for free at GoldSilver.com.
Welcome to the next in our series of updates, and this is the stock market bubble update, or STIMB update for short. And we've got the stock market bubble sitting on all of these pins. And some of the pins are that the Fed is trapped. They've got raging inflation right now. And the Federal Reserve needs to raise interest rates. And raising interest rates is a pin on a stock market that is in a bubble. If they don't, they've got inflation. And inflation is a pin that for a stock market bubble. And along with that, we've got the Ukraine, the war. We've got the instability of the global financial system. We've got just one pin after another pin. I've never seen such a convergence of pins with such an overvalued stock market. Speaking of overvalued stock market, let's get into how you measure these. This is Dr. Robert Shiller's CAPE PE10. It's the price earnings ratio of the stock market. So it's the S&P 500, and it is all of their stocks, and it's the price of the shares divided by the earnings per share. And what you see here, I noticed, on this first chart, I've got it, this is the way he creates his chart. I'm going to get rid of this line later because I don't like a chart that has too much stuff on it. I'm dyslexic. It makes it harder for me to see what's going on. But here, one of the things that I do see is something that's counter-cyclical between the stock market valuations and interest rates at first. So you have a peak in the stock market valuations that corresponds to a trough in interest rates, and a trough in stock market valuations that correspond to a peak in interest rates. And then there isn't much correlation in the overvaluation in 29, the subsequent crash causing the Great Depression from 32, and then in 1966, the peak, in that the stock market was in a bubble, not quite, and it's not the extreme bubble. This is an extreme hyper bubble, but it was in a bubble, and that bubble was corrected through inflation. It wasn't some giant stock market crash. Inflation corrected that bubble and brought PEs down to this extreme undervaluation. When you're down at 7 or less, that is a time to really go all in on stocks. You're not only going to get capital gains from a rising stock market after that extreme undervaluation, but you're going to get incredible dividend yields. You can get 8, 10, 12, 14% payments every year on your investment. And if inflation is raging higher than that, you can even get higher yields than that. But then we see that it correlated again back here. We've got this peak and trough lining up back in 1980-81, and then no correlation again for the overvaluation in 2000, the crash. This is the overvaluation. We're still up in extreme bubble territory. We're just not in hyperbubble territory here. But in 2008, that was a real estate bubble. We covered that in the second episode of your updates, the second update. And that crash was papered over by Ben Bernanke. So we got down to fair value only. We never revisited extreme undervaluation. Extreme undervaluation will come with a lot of pessimism in the stock market. You're going to be considered a lunatic if you invest in stocks the same way that anybody investing in gold since the year 2000 has been considered some doomsday lunatic, a prepper. But one thing you'll notice, let's eliminate the interest rates now that we've talked about those and just take a look at the PEs. And anytime that you get in this extreme overvaluation territory, and then you get into extreme bubbles, and then you get into hyper bubbles, there is something that happens. The reversion does not stop until you've revisited extreme undervaluation, and I believe you're going to see that happen again. You're going to see that it's going to be more like the crash in 1929, because the government is going to rush in to save us. There's going to be a lot of intervention. That's part of what caused the Great Depression, is the government taking what should have been a short-term severe recession, and they turned it into the Great Depression. But one of the things here, you get over this valuation area, and it doesn't stop until you hit this extreme undervaluation. Now, I think this crash is going to be quick, like the 1929 crash. When it's inflation that is correcting for the overvalue in the valuation in the stock market, it's a slower process. So the angle of this crash here on this chart is less. When it is just extreme market overvaluation, and then other factors, economic factors, it can be much faster. I believe that what's happening is this is pent-up energy from not letting this correction play out. If it had gone into the undervaluation areas and the markets started off from, if they had let the free market work, but they didn't, they had to intervene. Let's take a look at another one of the best. So we've seen the PE ratios. That is one of the best ways. This is another one of the best ways. We're going to take the Wilshire 5000 full cap price index. And so this is the capitalization of the companies. Now, wow, I see a little head and shoulders pattern up here that's been developing. Let's take a little closer look at that. Yeah, that's definitely a head and shoulders. And what you do is you flip that upside down after, if it continues down, if the stock markets don't go up from where they're at now, if they continue down and break that neckline, you should see a plunge equivalent to the size of that head above the neckline. There will be a plunge going below it. There are a couple of other head and shoulders patterns that I could show you here. Here's one, and there's the other shoulder. And then when it broke it played out. You flip that head upside down. There's a little head and shoulders here that did not play out. And so it's not 100% of the times, but it is one of the more reliable indicators. But what I want to show you is I want to take this and I want to add another index. And the way you do that here, I'm going to add GDP. And then you get this list, and you don't want to select anything that says real in front of it. We want an absolute number, not something that's been adjusted by inflation or whatever. So here we've got GDP quarterly, billions of dollars, going back to 1947. So that's a pretty good data set. I'm going to add that, and then I'm going to create a formula here. I'm going to divide A divided by B. So it's the Wilshire 5000 full cap price index divided by gross domestic product. And here we go. And so this is called the Buffett Indicator. And what we see here is back in the early 70s, it was the stock market valuation, the prices of the stocks. If you put them all together, it's somewhere around 80% of the economy, and then it went down to about 40% of the economy. Now, I have some data that's going to appear in an upcoming book of this same thing, but it goes back another 100 years. It's not as solid. The data is not quite as solid because it's derived from newspaper articles and things like that. But what it shows is that this 40 to 60% area seems to be the equilibrium point, and that everything that has happened this century has just been totally insane. But we got up to 1 1/3 times the economy in the 2000 when the tech bubble popped, And then during the real estate bubble, the stock market was the size of the economy. And you know what? These companies pretty much make up the company. These are the 5,000 largest companies. There actually aren't 5,000 publicly listed companies right now. I think it's around 3,500 or 3,000, something like that. But these are all of the publicly listed companies, the largest companies that make up most of the GDP. So we're dividing the products and services that those companies make and what they earn on them. The last chart, the PE ratio, was taking the earnings of the company that create the economy. These companies create the economy. They have no business being double the value of the economy. And so this will come back down to earth. It will revert to the mean. And usually, if the crash is not papered over, it will shoot past the mean before the reversion is completed. Now, another thing that affects that is margin debt. And this is from a great article by Wolf Richter of wolfstreet.com. And this is FINRA data. It shows that the stock market margin debt, according to FINRA, was about $940 billion, up from a little over $450 billion, 465, 70 billion. So almost doubled. But I want to go back even further to see, what seems not insane. And what we see here is this is the Federal Reserve's security brokers and dealers margin accounts at brokers and dealers asset level. And so this is just before, this is the NASDAQ crash here. It was extremely overvalued at less than 300 billion. And then we've got the global financial crisis of 2008. It was at 400 billion. And now we were almost at 600 billion here. And so the margin debt, I used to have something I created called the market fragility index. I would take the ratio of the margin debt as a percentage of the stock market value, like as a percentage of the S&P 500. And then I would take that result, I would take the Wilshire 5000 full market cap index times that result of somewhere between 0.4 to times 2 now. And it sort of exaggerates what's going on in the stock market. But the lower the debt, the more stable the stock market is. The higher the margin debt, the more fragile it becomes, because the Wilshire 5000, the Buffett Indicator, shows how top-heavy the market is, how much overvalued it is. But when you get into margin debt, this is the cracks in the system, the fragility that it creates, because when you're borrowing, especially if you're borrowing high leverage, an amateur might be allowed 3-to-1, and a lot of people are margined at 5-to-1. Professionals are margined at 10-to-1, 50-to-1, and if you're at 10-to-1, a 10% move to the downside in that stock wipes you out. So you have your fingers hovering over the sell button at all times, and it makes the market a lot more volatile when that happens. And so we're at insane levels that could speed up any market crash. And so, do you think that the bubble might pop, or do you think that the bubble will pop? Is it a matter of if the bubble will pop or when it will pop? I believe the bubble must burst. And when bubbles burst, it can be very messy for the economy and your personal finances. So protect yourself. Good luck. We'll see you in the next video.
goldsilver.com. Price match guarantee. Free shipping. Global storage options. Phenomenal customer service. Get the best-selling book, Guide to Investing in Gold and Silver, for free at goldsilver.com.